On Solana, capital moves at breakneck speed. Millions of dollars flow into new liquidity pools every hour, but the vast majority of that capital is wiped out almost instantly by serial scammers and rug pulls. The problem stems from the network's core design. In a permissionless, completely anonymous ecosystem, a retail trader has no way to distinguish a legitimate, committed developer from someone spinning up their 10th scam of the week. This flowchart shows RepScore bridging that gap. The V1 protocol reads raw on-chain data, assigning immutable credit scores, 0 to 1,000, to every wallet. Capital deployed faces a binary outcome, sustained liquidity and success, or a developer rug pull going to 0. Deciding whether to use a tool like this requires understanding the trade-offs. We need to evaluate what these algorithmic scores actually mean for a retail trader's risk profile, and look closely at how builders use them to actively block fraud. Moving from anonymous speculation to verifiable on-chain reputation changes how participants judge a wallet's past actions before committing their own capital. To understand the score, you first have to understand the data. The algorithm ignores anything self-reported. It relies entirely on unfakeable actions baked directly into the Solana ledger. Here is a tiered risk table breaking down exactly how that score is calculated. The heaviest factor, 30% of the total weight, is launch history. Because 99% of pump.fund tokens die within an hour, simply surviving your first few hours on-chain heavily boosts your score. Adding other positive, verifiable inputs, like locking liquidity voluntarily or retaining holders past a 30-day cliff, will quickly elevate a wallet into the established tier, or the highly coveted verified tier starting at 850. Conversely, negative actions are punished severely. Fast developer dumping, or holding an active freeze authority over the token, will violently drop a score into the flagged or blacklisted tiers. This presents the first major trade-off for a trader. If you strictly buy tokens from verified wallets scoring 850 or higher, you minimize your exposure to absolute disasters. But you also completely filter out the massive early upside of a first-time developer hitting it big in the market. The secondary trade-off is just as tricky. If you refuse to interact with any wallet scoring under 400, you protect yourself from repeat offenders. But you also lose the chance to buy into a potential turnaround from a developer who was previously clumsy, but not actually malicious. The algorithm also directly penalizes wallets that use crypto mixers or stealth tools to intentionally obscure their funding histories. While slashing the scores of mixed wallets effectively protects retail from money laundering operations, it inherently punishes legitimate, privacy-conscious users who simply don't want their balance broadcast to the world. For a trader, RepScore functions as a filter. You intentionally sacrifice the chance at explosive, unproven upside to gain a layer of quantifiable baseline security. For the developers launching these tokens, proving your legitimacy is a constant battle. Honest builders need a mathematical way to separate themselves from the daily noise and show wary communities that they are actually safe. That embeddable score badge serves a highly specific social function. It gives a developer instant, unfakeable proof of their track record right on their project website or Telegram. But transparency has a price. By verifying your wallet, you subject yourself to permanent on-chain scrutiny from the wider community. A single failed launch or one bad liquidity decision will permanently scar your public profile. Take a look at this integration diagram outlining how builders can go on the offensive. Launchpads can set up an on-chain program-derived address, or PDA, that queries a buyer's RepScore before allowing a transaction to process. Setting a strict minimum score requirement automatically rejects serial ruggers and bot wallets, completely locking them out during the project's most critical, vulnerable early buying window. Here is the core builder trade-off. Enforcing this gate maximizes the long-term stability of your project, but it artificially chokes off your total initial capital by rejecting a huge wave of unverified money. Developers have to decide exactly what kind of project they are running. You have to determine if securing long-term institutional trust is worth sacrificing the sheer velocity of short-term, low-quality liquidity. We also have to address the blind spots. This is a V1 on-chain analytics engine, and it is crucial to understand exactly what it cannot prevent. This checklist compares the system's catches against its failures. The most glaring loophole is the new wallet problem. Malicious actors can easily circumvent their bad history by simply generating completely fresh, unfunded accounts. Because these fresh wallets have zero history to grade, they bypass the blacklisted tier entirely. The algorithm is forced to assign them a neutral, unproven score, ranging from 400 to 599. This forces the end user to apply strict discipline. The protocol simply cannot preemptively flag a scammer who is operating with a completely blank slate. The platform uses behavioral fingerprinting and funding trail analysis to cluster suspicious wallet networks together, but the developers themselves admit the system will never achieve a perfect catch rate. The protocol provides legitimate builders a mechanism to verify their clean history permanently, even if a fraction of bad actors continues to operate through fresh accounts. Deciding to integrate or follow this tool depends entirely on your specific role in the market and where you need your capital to end up. This action matrix maps out exactly how to proceed based on your risk tolerance and your user profile. If you are a risk-averse trader, you should strictly enforce an API lookup rule for scores over 600. This isolates your capital from the vast majority of rug pulls and developer incompetence. If you are a high-risk sniper looking for early momentum, treat blacklisted wallets as an absolute hard stop, but accept the unproven 400 tier as a necessary, calculated gamble for higher returns. And if you are a long-term builder, absorb the friction of PDA gating immediately. Rejecting bad liquidity early is the only path to eventually achieving the rare legend status of 1,000 points. For this standard to actually matter, it requires widespread adoption from both sides. Traders have to demand verification, and builders have to be willing to provide it. In a permissionless economy, on-chain history acts as a permanent record of conduct. Choosing to ignore that data during a trade